Welcome to the latest edition of Fundamentals, where I'll be looking at the most popular investment trust on the AJ Bell Youinvest platform at the moment, namely Scottish Mortgage. The closed-ended vehicle is managed by Edinburgh fund manager Baillie Gifford, and it's a giant, with over £4.6 billion in assets. And this seems an appropriate time to look at the investment trust, as it's about to go into the FTSE 100 for the very first time. Scottish Mortgage, despite its name, lies in the global sector, and its mandate is to maximise total returns for investors through a combination of capital and dividend growth. Fund managers James Anderson and Tom Slater own just 38 stocks at the moment, and the top 10 holdings represent more than half the portfolio. So this is a focused fund, and it's one where growth stocks are generally preferred. Note that 41% of the assets are in tech and healthcare companies, as we can see here. Note that telecoms, energy and real estate have no presence at all, while consumer staples represent just 1% of the portfolio and miners less than 3%. So the emphasis is on capital growth, but do note the investment company offers a yield of around 1.1%, paid via an interim and a final dividend that come in June and November. Again though, growth is the emphasis. Anderson and Slater seek out firms whose competitive advantage means they have the potential to be long-term winners, and by long-term, they benchmark their performance against the FTSE All-World Index on a 5-year rolling view. Now, the top 10 holdings include Amazon.com, Facebook and Alphabet, the parent of Google, as well as US biotech player Illumina, electric car maker Tesla, and Chinese internet stocks Tencent and Baidu. Italian car maker Ferrari makes it in there as well. The fund's built stock by stock, bottom up, with no desire to mirror the weightings of any benchmark. But for those of you who would like to know, this means the US is the largest geographic position, followed by Asia and then the Eurozone. Japan has a 0 weighting. So, those are the mechanics. The question is, why would investors be buying now? And I think there are 4 possible reasons. First, the focus on secular growth stocks will appeal to those patient long-term investors who feel we're stuck in a growth-starved world clogged by debt, dogged by poor demographics and political sclerosis. Second, Scottish Mortgage is a global fund with only 4% of its assets in the UK. Shareholders will therefore benefit if the pound goes down as we get nearer to Brexit, as any news slide will increase the value of overseas holdings in sterling terms. Third, while we must note the past is no guarantee for the future, Scottish Mortgage does have a proven track record. This chart here shows the share price performance over the last 20 years, and while there has clearly been the occasional big bump, the long-term record's very good. In addition, Scottish Mortgage has grown its dividend for 32 straight years, enough to give it the 14th best streak among all investment trusts. That again reflects the good long-term portfolio performance, which by the way is helped by a low ongoing charge figure, and that's the 4th reason why people may be buying it. It's just 0.5%, well below the 1.2% average for the investment trust universe. Now, Scottish Mortgage may not suit everybody's investment goals, target returns, time horizon or appetite for risk. Only you can answer yourself those questions whether it suits or not. As we have seen, the shares can be volatile, although the gearing ratio is down to just 5% at the moment. Note also the shares trade at a 1% premium to net asset value, something else you might like to consider when researching Scottish Mortgage. This final graphic shows how that figure has changed over time and how until 2014 a discount of some kind was the norm. Thank you for watching, and I look forward to seeing you next time.